Good morning, folks. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is midweek with Jeff Zinaneri. It's our usual event. Jeff, welcome. I'm so happy to have you here. Let's get into it right now. We're in the middle of earnings. What do you think? What are you seeing in the market? What's going on? How are things going?
Market's been selling off for a few days now. And on earnings, on good earnings. So we started last week with the banks who had great earnings. They had amazing earnings, and the stock started to get whacked. Citi, for instance, had a tremendous report, and stock made a new high and then had a key day reversal. For the folks at home that don't know what a key day reversal is, it's a very important technical indicator that when a stock has been trending in a direction and they make a new high, but then within the same day, they close lower than the previous day's low, they made a key day reversal. And that happened in Citi. So I'm seeing that all over the news. I'm seeing it in all different sectors. Netflix came out. They were different. They had a crappy report and they're getting smashed for it. But you have to literally be perfect in your delivery of your earnings and have the stock not be like overstretched for you not to get hit.
Yeah. It's interesting that you mentioned Netflix particularly. I've been looking at Netflix, and a lot of people have been asking me about Netflix. And I don't want this to be a half-hour show about Netflix, but are you getting a little concerned about them getting a bit toppy in light of all of the competition they have? I mean, it seems like a no-brainer at this point that things. I mean, it's getting a little sizzling.
You know what they do, Roger? They sneak in like an extra $2, like you're not paying attention, and like I just recently got really. For those of you that at home that don't do this, every now and then, check out your bank account and focus on bills that are like charges that are under $50. You will find that you have a plethora of these sneaky charges under $50 in your account. Signed up for the Wall Street Journal, whatever. And they just like sneak in these incremental increases in prices. So when I initially signed up for Netflix, it was like $11. And I just looked the other day and it was $19. I'm like, wait a second. $19, whatever, but still it matters, right? If you do that,
it adds up. If you have
$100 a month out of your pocket, that's $1,000 a year. So I'm starting to do a little bit of inventory. I'm going through my house. I'm asking my kids, like, how much Netflix do you really watch? And like, no, we love it. No, you can't touch Netflix. But you hear what I'm going with this because they watch because they're, but then the next step is going to be, okay, let's prioritize, put it in a list, Disney Plus, Netflix, put them in order for me. Most important to least important. And I suspect Netflix might not be at the top anymore.
That's the problem. That's it right there. But you're still paying more and more and more, not less and less and less. It seems like they have less original. It seems like they're giving you less and less and less for charging you more and more and more every month.
They are. Yeah.
What you just said, I had about 100 people saying exactly the same thing in my VIP room. One guy said, I just keep changing the tiers lower and lower and lower. And now it's getting to a point where it's not going any lower. But I think the company is going to be facing some issues because the way they've been dealing with everything is they've been just opening up their pocketbooks. And they've been literally, hey, original content, no problem. We'll write Chris Rock a check for $50 million or Chappelle to do another comedy special. But after a while, it adds up. And I'm seeing, and like you said, Apple, Amazon is now Amazon's right now just made an announcement. They're going to start going real serious, and Amazon's got money. They've got a lot of money. So I'm a little concerned. I'm a little concerned that the fizzle or the sizzle, however you look at it, is going to start impacting Netflix, and I think it's going to be an issue.
Yeah, probably not wrong. The thing is, my problem right now, Roger, is that. I do fundamental research as you do. We also use technicals. We also are, we're seasoned veterans. We look at macro, we look at bonds, we look at rates, we look at liquidity, fine. But there's such a disconnect between stock market pricing and fundamentals right now that I don't know where to start or stop with, you know what I'm saying? Like I was reading last night that Dogcoin had a larger market cap than like Ford and somebody else combined, like two big, real Kraft. That's it. Kraft and Ford had smaller market cap than Doggy Coin, which was a joke when it started. And it's like, so how do I sit here and rationalize fundamental? Like, where does it begin? Where does it end? I don't know. Everything's kind of upside down. What's working for me is much more technical, and the stuff that you do, like, when stuff is starting to like really break down and the volume is increasing and it first breaks under its first moving average, then you can do a Fibonacci retracement and see how much more it can sell off from there. I'm using those kind of systems for timing, because like fundamentals are so broken across the board, in my opinion, in a lot of things.
Yeah, I mean, look at how it's. I mean, the best example of that, of what you just described, is look at Warren Buffett. He's been suffering the last several years, not several months, several years. He's missed out on some of the biggest trends we've had. His methodology is just completely, which is based on value and fundamentals. It's just dead in the water. And you're absolutely right. How do you make heads or tails out of what's going on right now, where you're seeing price ratio, momentum levels everywhere you look? You're like, man, this is just craziness. What do you do with it? I mean, it's a problem, and especially with low interest rates. So it's kind of like, do you continue moving in that direction, or do you say I'm out, and then you miss out, and then you miss a huge move? It's
reality. I mean, the Fed's putting $80 billion worth of, new dollar bills, every month into the game. And it's like, so where are those 80 billion going to go? And there's a multiplier effect. It's more than 80 billion. It's really like when you multiply and leverage everything, it's really closer to 5 to 10 times that. Right. So between $500 billion and $1 trillion got to find a home around the world, money wise, every month. Think about that. So, there's only so many Euro bonds people are going to buy, and Euro dollars, and they look for other things, and they're looking for bigger, juicier returns, and that's where you get into the slippery slope. All these things are happening because of liquidity. That's why fundamentals don't matter. That's why in the long run, fundamentals will matter. And I believe when the tapering inevitably start, when they will not be able to buy $80 billion of new assets every month, you're going to see fundamentals matter more than ever. And then people are going to really be like, wait, what am I holding in this bag? And they're going to say, oh my gosh, they're going to be holding their nose looking at some of these stocks.
Right.
And you're starting to see that a little bit with the earnings reports, because people are having, like, look at the UAL. All right. Yeah. Big shock. Airlines aren't making any money. They're not going to make the same money for a while. Right. Stock was down 10% yesterday. So people are looking at their inventory and they're like, oh, but the momentum was good. I was writing it. But then it's like, but then they have to answer. There's that moment of reckoning, and you got to have something to show for it. You can't say, my kid can't say, Daddy, I'm doing great in school. There's report card day. Then I got to see that report card. That report card's got to be in my face, and I'm old school just like you. Right. You don't do C's and D's in this house.
No. I hardly ever do B's. Yeah.
Right. What's the B for? Right.
So
earnings are like a report card. You get that. You can sit there.
It is a report card.
Yeah, you can sit here and you can tell the market all day long, we're kicking it. We're crushing it. Things are coming back. And then, you come there, and then how much did you make?
Exactly. Yeah. Babkas. Exactly. I couldn't agree with you more. Well, in light of that, what are some of the stock sectors? Give the readers at home some idea of, let's get a little specific. What are you honing in on? Me personally, I'm starting to get more defensive. I'm noticing that the bond market is moving choppy, as I anticipated that it would after such a big move, going from 0.93 to believe it or not, I'm still singing the same old song and dance with industrial material, but I'm actually going one step deeper, and I'm going into utilities and consumer staples now. And I think we're going to see.
That's defensive.
I'm getting defensive right now. I think the market is setting itself up. And again, I don't want to be the guy that's always crying wolf, that's always running, that's always bearish. That's not me. I'm a very bullish guy. But we got to be reasonable. We got to be responsible. People listen to this, and there's a lot of things, as you're saying, there's a lot of cracks in the foundation right now. Specifically, in regards to,
just because the S&P is a couple of percent off all-time highs doesn't mean certain sectors aren't getting tortured. Look at EV.
Exactly.
Is in a house of pain right now.
So
we would be like not doing like our fiduciary responsibility as people talking about the markets if we didn't shine the light on what's happening when you see some of the excesses taken out of asset prices, because it's happening.
The words you chose to use, pain, was exactly the word that I was about to say when you talked about EV. EV equals pain. Exact.
Torture. SPAC hell right now. Nobody's talking. They don't talk about it on TV anymore, but we were talking about it.
Yeah.
And so I'm not trying to be negative, but I'm trying to say, like, you have to look at where your pain points could come from. And you have to look at your portfolio always from a risk standpoint, because we're all conditioned to look at the goal. I want to hit the open goal, but you have to see who's going to block your shot. You have to take a survey of the land first.
Right. Absolutely. Could not agree with you more. Well, are you looking at anything specific, anything that's on your target right now, on your radar?
I'm paying close attention to the VIX right now. VIX gets above 20. You could see a 5% correction in the market, lickety split. I mean, we've had like, a little bit of we had VIX bottom out. We had VIX bottom out this week at 16, and now it's back like 18, 19.
Right.
But this was multi-month low in the VIX, and it's starting to come off that multi-month low, and you're seeing these different sectors. And so I'm being defensive and cautious, but from a timing perspective, I think if we see VIX get north of 20 here, you're going to see you could see some real pressure in equities for sure. That's one to buy. It'll be one to buy because I think we invariably end up going higher because of all this liquidity. It's going to still have to find a place to go home. But just know that we are on the precipice of a crack on the upside in volatility.
I could not agree with you more. And as you know, I'm a big momentum guy. We had the number of stocks in the S&P above the 200-day moving average at 95, Jeff, last week, which is the highest level we've ever seen in history. Forget 20 years, highest level we've seen. So even if we cool off, and if I do my sector analysis, there's a deviation. I always talk about fragmentation in sectors when they're not next to each other. Right. And usually you'll see consumer discretionary and technology. You'll see utilities and consumer staples. They're sectors that trade next to each other. They're like basic material and industrial. They're yin and yang. There's a spread right now. Between tech and consumer discretionary. Things are not humming like they usually do. There's definitely a stretched out market right now. So it's interesting that you're seeing exactly the same thing that I'm seeing, but from a completely different perspective. And I agree with you on VIX. And by the way, for those of you at home, I just want to take a little turn here because what Jeff is talking about, the volatility. Remember, the VIX is a real life implied volatility measurement on the S&P 500. It's the only implied measurement of implied volatility that you're going to get, and implied volatility is mean reverting. Okay, it has a notorious history of being mean reverting, because that's why we compare historic volatility to implied volatility to see where it should be. So just to take what Jeff said one step further, there's a very strong indication that volatility is going to ramp back up because it was historically below historic levels, and now it's moving back up. So I just wanted to clarify that, and for those of you at home, I wanted to make sure you guys understand what we're talking about. And volatility, the momentum levels, the sectors, it's all pointing to the same thing. Any global events, bond market, anything aside from the stock market that you're seeing influencing the stock market, aside from earnings and so forth, the bigger picture? I'm trying to
pay a lot of attention to China. China is like a news factory. China's affecting everything in the world right now for people that don't know. I mean, they're doing things and they're saying things and they're acting against companies that are domiciled in their own country, and they're acting against foreign companies like Tesla. And there's a radicalism coming out of China that we haven't seen in a long time. Of course, they've been communist for a long time. The Mao Revolution was what was it, 70, 80 years ago? And
it wasn't all that long ago. No.
What? No?
No, it wasn't all that long ago. No, I'm agreeing with you. I'm saying it wasn't all that long ago. Yeah.
Right. Yeah. And but they're radicalizing the Communist Party of China is becoming more radical in
they're becoming more paranoid.
They're becoming more paranoid. They're becoming more radical. They're doing aggressive things against the game, against capitalism. They're doing aggressive things, potentially to their own detriment, as you and I have talked about before. They're getting paranoid about. They're limiting their own company's growth. Like this Ant-IPO that Baba was going to spin out, this consumer finance company in China. They could have been like a PayPal and Square all rolled into one for China. And they literally were like, No, you can't.
Yeah. Yeah. It's amazing that, it's an amazing mentality, we got to prevent our own companies from getting too big because they may have too much control. I mean, man, this is your country.
I don't want to, there's probably people listening to this that are in China, that are in different countries. And I'm not going to sit here and make some sort of moral argument and think I'm superior, because I don't know that.
No,
What I do know is I'm trying to make money, and I want to be with pro money making people to do that. And I'm seeing a lot of red flags coming out of there, and not just, and also geopolitical in terms of how they're dealing with Taiwan. And I think there will be an act of aggression, an act of military aggression against an external nation state in Southeast Asia at some point in the next 6 months.
Well, let's back up. I would not discount that at all. I would not discount what you're saying. I think it's very likely, especially in light of the financial turbulence that they're seeing right now.
Yeah.
But here's an interesting thing. And this is straight up with China and the Russell 2000. As you know, the Russell has been lagging behind a little bit. And,
right.
I've been connecting the growth of Russell 2000 to China over the last, since you and I have been working together.
Yeah, you have.
Yeah. And what I'm seeing right now is kind of interesting. And for those of you at home, kind of listening to this for the first time or maybe second time, let me just kind of bring you up to speed. It'll be very, very fast. In a nutshell, the Russell 2000 seems to be very, very correlated to the NASDAQ 100, to the S&P 500. But a few years back, Donald Trump, our old president, he started a trade war with China. And as soon as he started that trade war, the Russell started lagging behind the S&P 500 because there's a huge sensitivity of the Russell to China, because a lot of those companies are Chinese companies or parts are made in China. Remember, the Russell's smaller. It's a one-trick pony versus conglomerates like Pfizer or Procter & Gamble. They don't have 1,000 different products and services. Right. So Russell 2000 started cooling off. And as soon as Biden, as soon as the first debate, the Russells just woke up and it started superseding. And everyone, including you and I, and again, I just wanted to bring people up to speed so they would have some context on what we're talking about. And then you and I, we assumed, and the rest of the world assumed, that Biden was going to be very, very friendly towards China in comparison to Trump. And it seems like that's not the case right now. And what does the Russell do? The Russell starts lagging behind again. I don't think it's going to go bearish again, but it is lagging behind. So my question to you, Jeff, now that I kind of loaded the question a little bit, are you surprised at how Biden is turning against China? Is that a surprise to you? And are you surprised?
Yeah, I am surprised, but it's also like China's like doing a lot of things. My point is China is a big actor and is a big part of why Biden is I'm very critical of President Biden across a lot of topics, but I don't think China's helping the Biden administration with any of these decisions or any of these policies, because they, again, are doing really radical stuff. Like, would it be shocking? Let me ask you a question, Roger. Would it be shocking to you if you woke up Sunday morning and got your coffee and you sat down to read the Wall Street Journal or Barron's or whatever, and it came across the tape that China is banning some major U.S. company like Facebook or something from being in their country?
It would have my undivided attention.
It would have your attention, but it wouldn't be surprising, is the point that I'm making. It wouldn't be like a black swan per se.
Not at this point. No, it wouldn't.
Signs are kind of like they're kind of like showing their cards that they want to.
No. I see
the game.
Right.
So you have to calibrate.
But my concern now is whether the Russell is going to go back into sleepy mode for the next 6 months, or it's going to start waking back up, because there's Russell
has another problem. Russell has another problem. The Russell rally was also in part predicated on the reopening story, on the reopening going tremendous, because Main Street USA, right?
Yeah.
A lot of these companies require economic activity. They're not gigantic tech conglomerates that make money while you sleep, no matter what. They're not cloud storage companies for the most part.
Exactly.
$50 billion a year just because they're charging you to have your data, like they need people to do stuff. And so that's part of the problem too. Yeah. And I'm nervous about that aspect.
Yeah, I'm very nervous, and I'm wondering because if the Russell doesn't get back up, it's going to have a big impact on a lot of these solar companies that you and I have talked about. There's a lot of pot stocks and a lot of solar companies in the Russell 2000, and they seem to be going back to where they came from before the Biden administration.
That's right.
Yeah, so that's which is why I wanted to spend a little time on this topic, because it's becoming an issue again.
Right.
So do you think the Russell has another rally in it, or do you think it's going to be very China dependent on fundamentals, or what's your take on this for the next, say, quarter or two?
I think the pain is going to come from the reopen and from the Russell. I think the real pain points are there.
Okay, so you do think we're going to lag for a bit, for quite a bit.
Not tremendously. I think like it's been a 10% lag in the last 30 days.
Yeah,
I think
roughly.
But
right.
It was a tremendous outperformance. So it's like I don't want to hem and haw, but I was on this thing a month ago and I was like, NASDAQ is up 2% on the year and the Russell's up 14% on the year. That's not going to stay consistent.
No.
Historically, that spread. It was a 2 standard deviation move. Historically, that's not sustainable. Right. So now since we've spoke, NASDAQ is up 7% on the year, and the Russell's up 10. And so, okay, so that spread has shrunk. It's coming a lot. It's coming like 10%. And so I think maybe a few more percent, but not. I think the downside is going to be in those black swans like China, the reopening not going well. I think that's what we have to look out for. Not tech breaking down to like
no earnings.
Get Google at 50% cheaper.
No, earnings are, and that's one thing that I was talking about a few weeks back. If you recall, I said as soon as earnings expectations are going to come out and we're going to see better than expected numbers on the tech, that's going to drive tech back up, because that's being compared to the yield on the 10-year. And it seems to be happening. It seems like they're back on par right now. But I am still seeing a lot of issues with FANG stocks in general. Netflix, one of them we discussed in depth today. So let me ask you, before I let you go, any pair trades that you want to discuss? And again, you can talk about closed trades, open trades. You can talk about metaphors. I just want to get your take on anything happening in the pairs world.
In the pairs world, I've been full Monty disclosure. I've been trading the QQQ IWM spread. So I've been long short IWM spread for a few weeks, but I'm looking to get out because I think that thing's run its course. Like I'm looking for a few weeks. I'm looking for those kind of moves. I've got nothing really new on that front. I'm looking at a sector that it looks like it might roll over here, which is oil. Oil drillers, and oil made a nice move back above 60 and the stocks did not follow. And that's always a sign for me, because oil made a move that you didn't expect it to make, a big one after some heavy selling, and the stocks didn't go up. The stocks are pricing in bearishness. Oil starts to get bearish. It's a little bearish today. You could see a real puke in those names.
Yeah, and again, for those of you at home, remember, folks, the oil sector is the only sector. I believe it's the only sector. I may be wrong, but I believe it's the only sector that did not take out last February, March highs, which we talked about. So when you're looking at it on a longer-term chart, it looks more like a pullback than a recovery, because I needed to see everything take out last February, March highs before going bullish, and it still hasn't. So if you are right, which I have no reason to believe you're not, it seems very, very logical. It would make perfect sense from a technical perspective and from a fundamental perspective as well, because God knows we have so much oil, Jeff, right now. It's just ridiculous, absolutely ridiculous. Before I let you go, last topic, and it's been a sore topic. Gold. What do you think about gold? Making a back another move up, or fizzling out for the rest of the year?
Gold's tricky, man. I mean, you think it's going to die and then it doesn't die. It's supposed to rally with the reflation trade. It doesn't rally with the reflation trade. I'm neutral.
Yeah, me too.
I mean, I hate to
get neutral. Hey,
going.
That's a position. That's a position.
It's a 50. I'm on the sideline. It's a 50-50 ball to me. I mean, gun to the head, gold goes back to 1850, or gold going to break down under 1600? I don't know. It's 50-50 to me. It's very scenario could happen.
It's very interesting right now, because you've got China that appears to be recovering from the COVID at a really high rate. At the same time, they're causing a lot of havoc politically. Then you've got Japan. And India right now hurting bad. I mean, and Canada too. So
Yeah.
it's going to be a very interesting geopolitical environment. And as you and I both predicted, the road to recovery is not going to be binary. It's not going to be zeros and ones. There's going to be some bumps in that road, and we're seeing them. We're seeing those bumps.
Which we really have to keep our eyes on is liquidity from the Fed and volatility, because
Yes.
everything is deriving from that.
Yeah, and folks at home, I want to remind all of you, we are still in a very strong bull market, and in a bull market, you will see a lot of cyclical rotations.
Oh, yeah.
Cyclical rotations are very healthy in a bull market. So just because we're seeing utilities lead or defensive sectors lead, it doesn't mean we're going to see a bear market. It just means that there's healthy rotation taking place, which is very positive and good for the market overall. Jeff, this was a wonderful, wonderful session. I'm glad I got a chance to take a little peek inside your mind this week. Folks at home, if you're interested in reaching out to Jeff, please do. Neither of us bite. We will answer your question, and we love hearing from you. And it gives us great ideas to hear what you guys want to hear from us. So please feel free to reach out, Jeff at Joy of the Trade, Jeff at joyofthetrade.com. And you could reach me at my personal email, support@marketgeeks.com. Again, Jeff, this was a wonderful session. Thank you very much for taking your time. And I will touch base with you later in the week. Take care, my friend. Bye.
Take care.